Rolls Royce Holdings has one of those names that people perk up when you mention it. An industrial design, developing, and manufacturing company that is world famous for its incredible engineering designs. Now that it's making tens of billions of US dollars annually, it does have multiple segments. First up, the civil and aerospace segment is all about commercial airplane engines, as well as all the aftermarket maintenance repair services that do sustain a long-tailed customer value equation. Right up there, next in line, is the power systems segment. This is the segment I personally find the most exciting. Maybe you do too. It includes engines, power systems, and nuclear systems, all related to civil electricity generation. Here they say civil power. That's electricity generators. Let's keep that in mind as we look at one of the premier electricity generator designers on the planet. A third segment, also pretty exciting for some people, the defense segment. This is military aircraft, naval craft, submarines, and all the aftermarket services for maintaining those. Especially in this segment, the aftermarket services is a very big deal. Of course, everyone wants their machines to be maintained very well, but when it comes to military contracts, the maintenance is near constant and can be very, very profitable if you're good at what you do. Lastly, there is a new market segment. This is much smaller than the others. It's for research and development. Here they're specifically calling out right now alternative electrical solutions and small modular reactors. I mean, that is Fallout TV show, video games type science fiction stuff in real life. Kind of cool. Thanks to MarketWatch.com, we're going to look at the profile of this business. For anyone that's new, we have a valuation section, a profitability section, an efficiency section, a liquidity section, and a capitalization section. The tradition on this channel is to not overload us with every single statistic. That would be insane, and that is not how I invest on my own. Right off the bat, in profitability, this return on total capital is very high, especially for an industrial goods defense contractor. About 6 to 7 times larger than the net margin right up here. This big difference between the net margin on the income statement and the return on total capital in the cash flow statement immediately tells us what we need to know about this business. It's hit economies of scale that allow it to be depreciating substantial, I would guess billions of dollars annually, which is how a 13% net margin gets inflated to a 70 plus return on capital. This business is like a huge train already at speed on the tracks. It's not going to be steering very effectively. However, the question is, do we like where this business is already headed? Now, at the valuation section, the current price for this is a PE of 33. Before you click away, the channel is called Value Validate. I am a value investor, very proud of that. And yes, it's not often that I'm going to look at a 30 plus PE and say that's anywhere near value. But in this case, I'm going to make the argument. Stick around and I'll make that argument very clear. Now, some of you might be tempted to say, hey, Sage Seed, look at PE ratio without extraordinary items. This is a much more palatable 19 PE. And to that, I would say, don't waste our time. 19 PE is still way too high for me to get excited about as a real value investor. No, no, no. This is a value investment because total debt to enterprise value is 11%. Total debt to total capital is huge, 121. This company has a lot of debt relative to the capital that its business requires. Yet that total debt is really small compared to the enterprise value. You add these two legs to the very solid torso of return on total capital in the high 70s. And this is a compounder, guys. This is a fat compounder already up there making billions of dollars. When you find a compounder, I like to worry about like how defensible is this company's market position, because you could be set up to compound very, very nicely and you still have to worry about competition. This is a chunky boy. Rolls Royce Holdings is at a size where it is not going to be too bothered by losing some customers here, losing some customers there. There's the argument. Don't believe me? Well, I wouldn't make a promise to you without getting into the details. We're going to look through various articles, all of them targeted to potential investors in Rolls Royce. And yes, what we're doing is validating a value in Rolls Royce Holdings. Let's dive in so that your wisdom can blossom.
This video is intended for educational purposes. Opinions made by me or the Sage Seeds AI are not investment advice.
And so one thing we're going to notice is that Rolls Royce shares have been going up a lot. And I mean a lot. Immediately, the motley fool, thanks to Zavin Boyrazian, he's a charter holder, nice, Well, yes, the very reasonable question. Rolls-Royce share price, are we near the peak? This is going to give us a lot of the context that we want to know as potential investors right now. The last 5 years have been an exceptional period for the share price and its shareholders. The once struggling engineering giant has seen its market cap expand just shy of 1,000% since July 2020. In the first half of 2025 alone, the shares have climbed 68%, which is an accelerating upward momentum. Lofty valuation, already making a disgusted face, I really am. But I'm seeing this a bit like eating my broccoli. And that's kind of a bad example for me. I actually really like broccoli. But you get what I mean. Compounders are not going to come cheap. Let's just get that out the way right now. If you show me a compounder with a sub 10 PE, I guarantee you're being made off. You're going to lose that money. That's not a real company. So just suck it up and read along with me. It doesn't take more than a quick glance to recognize that Rolls-Royce share price might be getting a bit too big for its britches. Oh, this is a UK company and UK analysts are gonna be throwing all sorts of weird phrases at us today, aren't they? Free cash flow generation, now in the multi-billions, is giving ample financial flexibility to control debt while also increasing investments into future innovations. At the same time, rising geopolitical tensions are serving as an organic source of new demand for its defense-focused operations. What to do now? Well, overall, the average consensus forecast suggests that Rolls-Royce shares surpass their fair value at around £9.20. Now, we're going to do the conversion to US dollar for most of the video, but the key point here is whatever is being reported as fair value by the Motley Fool has been surpassed already. We are very much looking at a situation where any investment into Rolls-Royce would be us actively saying that we expect more from this business than the professional consensus. And so another Motley contributor, Stephen Wright, he says a very similar thing. Is it too late to buy Rolls-Royce? How much higher can it go? Well, according to Peter Lynch, many value investors should recognize that name, one of the GOATs. One of the biggest mistakes an investor can make is assuming shares that have gone up can't go higher. And wow, there's a bit of a history nerd. Stephen Wright is a bit of a history nerd. He's sharing Lynch's famous Altria trade. Peter Lynch was a value investor that was way more on the growth side of things, believing that future growth is worth paying up for. Over the long term, the important thing is the company's scope for international expansion and the strength of its brands. There are three major sources of potential growth for investors in Rolls-Royce Holdings to pay attention to. Number one, possible expansion into narrow-body aircraft. Rolls-Royce Holdings actively looking to use its UltraFan technology to produce a more efficient engine in narrow-body aircrafts. If it succeeds, it could significantly increase the company's addressable market. And this does have a dynamic in play with the industry-wide shift to sustainable aviation fuel. Rolls-Royce Holdings is arguably further ahead than most airplane engine competitors in having products that impress in this new world with new standards. And finally, this R&D thing we looked at the very beginning, calling out the small modular nuclear reactors R&D product, while in its early stages, the company has a very strong competitive position in the modular nuclear reactor industry. For my Fallout nerds, if any company on the planet is going to start manufacturing Pep Boys and Vaults, probably going to be someone like Rolls-Royce Holdings. Still an opportunity? The stock's expensive, but the firm has some clear competitive strengths that should serve it well over the long term. Stephen Wright says it's not top of my list to buy right now, but I do think it's worth keeping in mind. Thank you very much for that transparency, Stephen. Let's keep going. MarketBeat.com, Rolls-Royce Holdings shares cross above the 200-day moving average. Here's what happened. Now hold up, everyone's saying Rolls-Royce is going up, is going up, is going up. How did it just last month cross above the 200-day moving average if it's supposedly been exploding for years and years and years? Well, after reaching a 52-week high of $12.29 US dollars, now we're in the US dollars, Rolls-Royce did very recently fall as low as $8.80. So analysts set new price targets. These are Wall Street analysts, moving Rolls-Royce Holdings from a hold rating to a strong buy rating in the months of April, March, and February of 2025. In addition, hedge funds are overwhelmingly acquiring Rolls-Royce Holdings during 2025 so far. Right at the top of that list is a 60+% increase in stake for PNC Financial Services. There's 3 or 4 notable Wall Street names on here, hedge funds buying Rolls-Royce, all very, very rapidly. And yet, as of about a month and a half ago, 0.8 0.07% of the stock is owned by institutional investors. Rolls Royce is a Canary Wharf retail darling, and Wall Street has really missed out on almost all of the gains since the pandemic. So here's what happened. It is 2025, and I would argue specifically summer 2025 is the moment when US Wall Street firms are saying this is real and finally recognizing Rolls Royce Holdings as a blue chip stock. Now, I'm bringing this up right now because it is not owned by most of Wall Street. But if Rolls Royce really does become an accepted blue chip stock, it's also an elite compounder. And you tell me, if you were a hedge fund manager, are you going to not buy the latest elite compounding blue chip stock? That would be a decision for sure. Let's keep going. Now on Rolls-Royce's investor relations website, Rolls-Royce increases U.S. manufacturing capabilities in South Carolina. These are power generation facilities that already have prepaid customers in the form of large data centers before they've even put a shovel in the ground. This engine plant is going to be making MTU Series 4000 energy generators. The South Carolina Coordinating Council for Economic Development has approved tax credits related to the project. These investments reflect the rapid growth of data centers in the US. That is right. This is the segment I'm most excited about. What I'm seeing is that data center growth is being bottlenecked by the electrical power grids of countries. These examples are in the US. The US would be one of the larger examples, but this is happening all over the world. Until your electrical grid can be grown naturally, organically, you have to tell all these data center and cloud companies to stop business or buy electrical generators from companies like Rolls Royce. Phase 1 construction is expected to be finished and production beginning by summer 2027. Rolls Royce then gives us the sort of strategic data points that they're using to justify this decision. As much as $1 trillion is expected to be spent globally on AI data centers and associated infrastructure. Not only do these generators that Rolls-Royce is manufacturing absorb this spend in data centers, but these backup generators are also important products for hospitals, municipalities, and government installations. These generators have been being built in Aiken, South Carolina since 2010. And for anyone that thinks that Rolls-Royce is just benefiting from trends, isn't really forward thinking at all, well, since 2017, this facility has been completely powered by its own solar power array. And so yes, do they know how to generate electricity well? I would say they do. Wall Street's been sleeping on a quality compounder. And I would personally ignore that, just let Wall Street pay whatever P it wants, if it weren't for the fact that the competitive position, the economics of Rolls-Royce are extremely plugged into some of the highest growing industries on the planet. It's doing all of that already. So yes, my hardcore value investor exterior is crumbling a bit, and I might seriously have to consider paying for an industrial company. Who am I? We're now going to go to the annual report. Some of you might be noticing that this is a PowerPoint presentation. 13.8 operating margin versus a 5% operating margin 2 years ago. Free cash flow going up by almost 5x. This is a compounder at its very core. And here now in the CFO section, we're going to start to get specific updates on which parts of the business are actually leading to these results. Because at the high level, yeah, the business is doing good to great, but why is it doing good to great? Well, revenue-wise, it really is a decrease in smaller regional aircraft engines, more than being made up for by an increase in revenue in large business class and cargo airplanes. When we look at the defense contract side of the business, we have relatively stable revenue, except for submarines, which are dramatically increasing. Now, Rolls-Royce Holdings kind of benefited from the specific product mix in the latest defense spending cycle. Power systems, again, this is my little darling segment, the one that I'm in love with. It's power generation and battery energy storage systems which are leading the charge. Organic change in operating profit of more than 40%. And in a cash flow summary, I actually really dislike this, by the way. If any British viewers care about my opinion on British accounting, these suck. Just make a cash flow statement. Don't show me, what is the summary funds flow? No, thank you. But that's what we have right now. We're not going to see the depreciation specifically mentioned, part of why I hate this, but we do at least get to see their definition of working capital. Look at this, they increased working capital by about 280 million pounds in a year when they made almost 2.5 billion pounds in operating profit. I mean, that's, an 11, 12% working capital margin. Very capital light. Well done. I don't know why it's so inexpensive to build submarines, but whatever Rolls-Royce Holdings is doing, keep it up, especially in a world where Wall Street firms have been kept pretty much out of the picture for the majority of your growth story. And we're looking at a 1 to 2% share buyback dividend, if you could call it. If we could get this to 5%, then we could really see some returns. Just please don't get distracted, Rolls-Royce. These British companies, sometimes they just get distracted, and I really don't want to see this happen to Rolls-Royce. But if I am correct, and they are just about to become a blue chip stock that people recognize, then let's just hope it doesn't go to their heads. I want Rolls-Royce Holdings to be the belle at the ball, but also continue to do the exact things that put them in this position. If you enjoyed this video, please leave a thumbs up and subscribe. I validate a new value investment every month,